What makes the Walt Disney Company a good investment? Well, it's one of the most strongest media companies in the world with a steady and predictable cash flow from its Disneyland parks. The company has a large competitive advantage from its brand recognition, its close reach to the customers, and a large and growing media content library. Now, Disney is a company that all of us have interacted with at some point in our lives. And on the surface, it seems like a very straightforward and simple business to understand. However, once you dig a little bit deeper into this company, you'll find that it can be quite complex. And this is perhaps to be expected from a company with over $70 billion in annual turnover. I will next try to summarize the many different business models of this company and explain what attracted Sifter to invest into this business in the first place. Now, Disney can be summarized into 5 different business units. The first and the largest of these is the so-called linear network segment. This is mainly the Disney's own cable TV business. And the most recognizable channel here is the kids' favorite Disney Channel, which shows various content from the company's large library of TV shows and movies. But the largest and most important asset here is the American Broadcast Channel, or ABC for short. This is the third largest cable TV and broadcasting channel in the States and is known for shows like Grey's Anatomy and Lost. In addition to these two, the company has the sports channel ESPN. This is a very large and very profitable channel, as sports fans around the world are quite happy to pay almost anything for access to live sports. Now, these Disney-owned cable TV channels are bundled by a third-party provider like Comcast or Verizon and then sold to the consumers through them. Disney then generates an affiliate fee from these companies. This has typically been rising by 7% per year, like clockwork. But on the other hand, as you can imagine, the people that are watching cable TV are going down every year. So far, this has been going on at a rate of 1 to 2% per year. So this means that even though currently this segment is growing, over time this will eventually decline. To hedge against this decline and to make the company viable in the future world, Disney launched its own streaming service in 2019 and very creatively named it Disney+. This was initially a wild card that did not have very high expectations, but the reception of this was indeed above both the company and the market's best estimates. And today there are over 140 million subscribers to this service alone. Now, on top of this, the company has the ad-supported streaming service Hulu and the sports streaming service ESPN Plus for a total of 205 million subscribers across the platforms. Now, the company expects to reach over 250 million by the year 2024, and at the same time expects that this segment, which is currently making losses due to the need of high content investments, will reach a break-even. Now, the content for these streaming services and the cable TV channels are generated in the Disney studios. These generate revenue from the sale of cinema tickets, but also from the distribution of Disney content to third-party services. And in fact, this is the most important asset that this company owns, as every other segment in Disney will benefit from the content created here. And they can then monetize it in different ways. I like to think of this as the trunk of a tree that feeds each of the other branches. And the fourth such branch is the parks and experience business, or in other words, Disneyland. The company has 6 parks, 2 in the States, 1 in France, 2 in China, and 1 in Japan. And these generate quite a lot of revenue from the park admission fees alone, but there's almost as much revenue coming from ancillary services like food and lodging. And then finally, the company has a merchandise segment that either sells toys or collectibles through Disney stores or through third-party vendors. But the thing that brings all these 5 businesses together is the media content, either animated or live-action pictures. Disney have their own organically created studios that have made classics like Lion King or Cinderella, but the company has also shown that they do not fear making quite bold acquisitions to obtain quality studios and quality content from elsewhere. The largest acquisitions to date have been Pixar 2006, Marvel 2009, Lucasfilm, known for Star Wars, in 2012, and 20th Century Fox in 2019. Now, in retrospect, these have all been very outstanding decisions, as is evident from the fact that the movies produced from these studios have given Disney 44 places out of the 100 all-time highest grossing movies, or 13 of the top 20. But the dark side of this venture is the worsening of the balance sheet, as both goodwill and debt have increased to high levels. Although not so critical, as the company still enjoys a good credit rating and has favorable access to capital. So what makes this company stand out from the perspective of the Sifter Fund? Well, firstly, the Disney brand, including all the acquired studios, is a very strong competitive advantage that's unmatched by any other media company. It doesn't even matter how Disney will monetize this asset, whether it's through streaming, through TV, or selling its content to third parties. The Mouse House is always able to generate a good return on its content library. Secondly, the parks provide a stable, predictable, and growing cash flow for the foreseeable future. The Disney World in Florida is a massive theme park, but is still overcrowded due to its massive popularity. Disney has been trying to counteract this by raising prices every year over the last 50 years, but this has still not caused a significant drop in visitor numbers. They are still going up. And then lastly, the valuation of this company was at the time of investment very attractive. Even though we had very conservative forecasts, including a decline in the cable TV and just a moderate upside from streaming, and a reasonable return to normal business conditions for the Disneylands, we still arrived at an earnings yield figure which was more attractive than the portfolio average. Now, for this reason, we lowered the weight of some of more riskier and perhaps more expensive investments to allocate funds to Disney. But what about the downside? Well, the biggest risk for the company at this moment can be summarized by 3 risk factors. Firstly, the pandemic and its associated lockdowns created losses for the company, as the Disneyland parks were shut down for some time. Secondly, the streaming market is, at this point in time, a very new business model, and it's not yet entirely clear whether to us or anyone else whether this kind of business can create sufficient return on capital, especially in an ever more competing market. And lastly, the legendary CEO Bob Iger decided to retire in 2020 after having led the company for 15 years. He was replaced by another Bob Chapek, whose personality and approach to leading this company is drastically different. Now, his first 2 years as CEO was spent on firefighting duty as the company was struggling through the pandemic, so we still don't have a good idea of what direction he'll take this company in. But what we do know is that he intends to focus very heavily on the streaming business. To conclude, I'll summarize this company as follows. Disney is the most iconic media company house, and its content is appreciated by a wide audience worldwide. The company can monetize this asset in many different ways, and it's very hard for the competitors to really compete with Disney, especially in its core audience. The company only has to perform quite modestly for us to generate quite a good yield on investment, and there's plenty of more upside than downside in this case, in our view, especially from the streaming service. So Disney meets many of the Sifter quality criteria for investments. It has a strong advantage from its brand, its products are always in demand, especially from the younger audience, and the company has a clear growth trajectory. Well, this concludes my introduction of this company. I hope you enjoyed this content, and I thank you very much for your time.